On March 29, 2012, regulators stormed the sleek downtown office of Peregrine Financial Group, uncovering a $215 million fraud that had been hidden for nearly a decade, money that belonged to the very farmers who had trusted the broker with the harvest of their livelihoods. Founded in 1999 by the charismatic former stock trader Mark D. Kennedy, Peregrine began as a modest boutique brokerage in the heart of Omaha, Nebraska. Its promise was simple: we'll take your hard-earned money and grow it the way you grow your corn, steady, reliable, and with a personal touch. Kennedy's background in commodities trading gave him instant credibility with the region's agricultural community, and the firm quickly became the go-to conduit for grain producers looking to hedge futures, invest surplus cash, and secure a financial safety net against volatile markets. Within 3 years, the firm's client list swelled from a handful of local grain elevators to over 3,000 individual farmers, family-owned agribusinesses, and even small-town cooperatives. Peregrine's glossy brochures featured testimonials from satisfied clients who claimed their wheat yields had been protected by the firm's sophisticated strategies. By 2005, the brokerage was reporting annual revenues of $45 million and bragging about a 20% return on client portfolios, figures that seemed almost too good to be true in a market still reeling from the early 2000s recession. Behind the polished veneer, however, warning signs began to accumulate. The first red flag appeared in early 2004, when a group of soybean farmers in western Iowa noticed that their quarterly statements consistently showed unrealized gains that never materialized into actual cash. When they called the firm's support line, they were met with vague reassurances. Your positions are locked in and the market is simply volatile right now. At the same time, internal documents obtained later by investigators revealed that Peregrine was using a single, heavily leveraged trading account to cover multiple client positions, a practice that violated both SEC regulations and basic risk management principles. In 2006, a whistleblower, a junior accountant named Laura Mitchell, noticed that the firm's ledger showed the same $2 million trade being recorded under several client accounts. She raised concerns with the compliance department, only to be told that the numbers are correct, and you're looking at it the wrong way. Mitchell's attempts to flag the issue were quietly dismissed, and within weeks she was transferred to a peripheral role in the firm's back office. The next warning came from an external audit in 2007. The auditing firm, overwhelmed by the sheer volume of transactions, issued a qualified opinion, noting material uncertainties regarding the valuation of client assets. Rather than address the discrepancies, Peregrine's leadership issued a press release touting a record-breaking year and promised greater transparency in the upcoming quarter. The firm's marketing campaigns grew more aggressive, with advertisements promising up to 30% annual returns for hardworking farmers. Despite these cracks, the firm's growth continued unchecked. By 2009, Peregrine had expanded beyond the Midwest, opening satellite offices in Texas and Kansas, and launching an online portal that allowed clients to monitor their portfolios with a few clicks. This digital push attracted a new wave of younger investors, many of whom were lured by the glossy testimonials and the promise of farm-backed stability. Yet the underlying structure remained a house of cards. The firm's chief operating officer, James Whitaker, later testified that cash inflows from new clients were routinely used to pay interest to earlier investors, a classic Ponzi mechanism that the firm concealed behind complex commodity contracts and hedge fund language. The inevitable collapse began in earnest when the 2008-2009 financial crisis sent commodity prices plummeting. Farmers who had relied on Peregrine's guaranteed returns suddenly found themselves unable to access their capital. In early 2011, a coalition of disgruntled clients filed a class action lawsuit, alleging that the firm had misrepresented its investment strategies and failed to disclose the high degree of risk. The lawsuit forced Peregrine to disclose, under court order, that only 30% of client funds were actually invested in legitimate commodities. The rest were held in a tangled web of offshore accounts, shell corporations, and fictitious trades. Regulators took notice. On February 22, 2012, the Securities and Exchange Commission announced a preliminary investigation into Peregrine's operations, citing serious concerns about the accuracy of the firm's financial statements and the safety of client assets. Within weeks, the firm's bank accounts were frozen, and employees were escorted out under armed guard. The final report, released in April, confirmed that Peregrine had siphoned $215 million from client accounts, diverting the money into personal real estate purchases, luxury vehicles, and a secret offshore trust owned by Kennedy and his inner circle. The aftermath was devastating. Hundreds of family farms faced foreclosure, their owners unable to meet loan payments without the cash they believed was safely invested. In the small town of Grand Island, Nebraska, a community gathered in the local high school gymnasium to hear the grim details of the fraud. "We trusted them with our future," said one farmer, his voice shaking. "Now we're watching the land we love being sold off." Legal proceedings stretched on for years. Kennedy was arrested in June 2012, charged with securities fraud, wire fraud, and money laundering. He eventually pleaded guilty and received a 30-year prison sentence, while several senior executives faced similar terms. The SEC ordered the liquidation of Peregrine's remaining assets, and a court-appointed receiver began the painstaking process of reimbursing victims. Subscribe to The Collapse for more stories like this.